Welcome to our Croatan Conversation. We will be starting in the next couple of minutes as we wait for everyone to join. Welcome to our Croatan Conversation. We will be starting in the next couple of minutes as we wait for everyone to join. Thank you for joining our Croatan Conversation on new frontiers in fixed income engagement, transforming bond markets through activism and advocacy. This is part of a larger series bringing leaders to working on the front lines of finance, social change, and ecological resilience into deep dialogue about collaborative opportunities to invest in solutions to some of the world's toughest social and environmental challenges. This is a project of Croatan Institute, an independent nonprofit research institute whose work is at the critical nexus where sustainability, finance, and economic development intersect. My name is Bill Harrington. I'm a senior fellow at Croatan Institute, and would like to thank Breckenridge Capital Advisors for hosting my colleague Christy Electris and me today in their offices so that we can work together in presenting the conversation. Susan, you can, next slide, please. This conversation is being recorded. Everyone is speaking for attribution and the recording will be available afterwards. For Zoom attendees with questions, please use the Q&A box for all questions. You can ask questions at any time and we'll do our best to answer those at the end of the presentation. If you're watching on YouTube, you can post your questions in the comments box. And again, we will do our best to answer as many as we can at the end. Susan, you can switch the slide. Next slide, please. While you're looking at the disclaimer, this presentation and the ensuing discussion is for informational and educational purposes only and does not constitute investment advice. Investors should consult with an investment professional before making any investment decisions. And because I think finance needs as much transparency as possible, I'm going to ask Susan just to leave the disclaimer up for another 10 seconds, just so people can understand what finance does and doesn't do. Thanks, Susan. The next slide, please. Our next Croatan Conversation will be on Tuesday, December 8th at 1 o'clock. The conversation is Trends in Sustainable and Impact Investing in the United States with Croatan Institute President Josh Humphreys and US CIF CEO Lisa Wall. The dialogue will reflect on the implications of major findings in the 2020 report on the US Sustainable and Impact Investing Trends report that was released on Monday. More detail can be found at croatanconversations.org, and we'll also post the registration link in the chat. Again, it's December 8th at 1 o'clock. Thanks, Susan. Next slide, please. I'm extremely excited to introduce very briefly our panelists today. Ryan Bowers of Activest. Ryan, can just, I guess people can see you, but you can smile. Rachel Robasciotti of Adasina Social Capital. Thank you, Rachel. And Benjamin Bailey of Praxis Mutual Funds. As I said, my name is Bill Harrington, and I'm a senior fellow at Croatan Institute. It's okay if you want to take the slide down, Susan. And I'm going to start off for about 5 or 6 minutes talking about my work, which is trying to improve the content of credit ratings. And the way to do this, in my estimation, or the way to accelerate this is by having fixed income investors and allies and other financial market participants submit methodology critiques directly to the credit rating companies. I worked as a senior vice president at Moody's Corporation, where I wrote common methodologies, and I wanted people outside of Moody's to comment on them. First of all, to get their insights, and secondly, when I was working with colleagues to try and make methodologies as robust as possible, it was useful to have external buy-in. And so whether you like your credit rating analysts that you speak with, but don't think that the credit ratings themselves are moving in the direction that you would like, or whether you would like to see a wholesale change of the people who run a credit rating company from top to bottom, or whether you think your sector should be credit rated differently, I think the way to accelerate and jumpstart this change is by submitting critiques on the credit rating methodologies. If people believe that addressing climate change, racial inequity, income inequity, or a host of other ranges is an emergency, and you believe that finance is not yet doing its job, and in the fixed income markets, because 4 credit rating companies dominate the credit ratings worldwide, there's an impact that the credit ratings companies have, even if your individual market, even if you as an individual issuer, and certainly as you as an investor don't rely on credit ratings. They do influence the price and the availability of capital in most sectors around the world. And I particularly think it's important now because there's a window with the election opening. We don't know how wide that window will be. We don't know how long it will be. And we don't know what room for maneuver a new administration will have. So I think, again, if people believe that climate change, racial justice, income inequality, from the work that I work on, which is the lack of governance in a lot of financial sectors and the credit losses that could emerge, if these are emergencies, then I think emergency responses are necessary. And critiquing methodologies is allied to 2 things that I think a lot of people do already. One is in the equity world, having shareholder resolutions. And another is in almost any world where we're trying to make change is filing comments to regulatory rule proposals. And submitting a comment critique to a credit rating agency, the 4 are DBRS Morningstar, Fitch Ratings, Moody's Investor Service, and S&P Global Ratings is very much akin to filing a comment with a federal regulator. Comments can be filed privately or publicly, and as with federal regulators, the credit rating companies must summarize the comments and also provide rationales as to why they are or are not accepted. The content of credit ratings themselves cannot be improved until the credit rating methodologies are improved, and that is intentional on the part of credit rating companies. Their legal safe harbor, their regulatory safe harbor is not with respect to content, it's with respect to disclosure. The 4 credit rating companies will all maintain that all of their credit rating methodologies are publicly available, that they're all available for comment by the public at any time, that all methodology overhauls are submitted for public comment, and that they rate consistently with these methodologies. My work is in the governance in the financial sector, particularly in the structured finance and derivative sector. That's where I spent most of my career. And I can demonstrate that many issuers in these sectors still do not capitalize their deals adequately. And one reason they still get good ratings is because the methodologies are so indeterminate. They're public, but they're too wide to have much meaningful impact on credit ratings. So I'm going to stop there and now ask Ryan Bowers of Activest. If you'd like to tell us about Activist, describe his work, his objectives, the resources that he has, and his allies.
Thanks, Bill, and great to see you and everyone this afternoon. Hi, I'm Ryan Bowers. I'm a co-founder with Activest, and based in the Philadelphia area. We describe ourselves as a voice for racial justice in the municipal market. And we approach our work from a fiscal justice lens. And we define really fiscal justice as the fairness of municipal budgets, the equity of municipal budgets. And really based on the fact that communities whose residents are better off have stronger long-term fiscal outcomes. We have three bodies of work. One is around investment research. And so we partner with amazing organizations like Adasina Social Capital, my colleague Rachel Robasciotti here, to provide ESG research in the municipal market, but really from a justice and fiscal justice and racial justice lens. We support cities by advising cities, budget directors, CFOs, around practices that could both lead to stronger fiscal outcomes and stronger equity outcomes as well. And then we also do bondholder engagement. So kind of taking a play out of the shareholder engagement, corporate shareholder advocacy playbook, and really mobilizing municipal investors to engage issuers around issues of transparency and disclosure, really from a justice lens. So those are our kind of bodies of work, and given our work is around these justice issues that have both kind of fiscal implications, but also like strong equity implications, we work on with a number of organizations that we see that are really dealing with material issues in the kind of related to local government health. So folks like the Fines and Fees Justice Center are great allies, as so many local governments since the Great Recession, and also since COVID started, are over relying on fines and fees, or implementing imposing fines for not wearing masks, and they have a disproportionate impact on folks of color who are a lot of times oftentimes pulled over because of race, and the racial profiling that goes up with policing in communities. We work with other folks like Action Center on Race and the Economy, ACRE, which we've done bondholder engagement work with, related to the city of Chicago's lack of transparency on police misconduct settlements, where those revenues are coming from, budgeting and then blowing their budgets every year for the amount that was set aside for police settlements. And then also other folks like, there's an organization that we grew out of Frontline Solutions, which does a lot of work around racial equity audits and advising foundations and nonprofits around their just justice and racial equity goals. So those are a number of partners. I'm sure I've left a ton of them off. Sorry if you're listening, but thanks, Bill.
Rachel, same question. Can you tell me about your work and objectives and resources and allies at Adasina Social Capital?
Absolutely. So I'm Rachel Robasciotti, the founder and CEO of Adasina Social Capital. We're an investment and financial activism firm. I live in San Francisco, but I was born and raised in a poor and segregated Black community in rural Northern California. Over my lifetime, I've had 3 different family members murdered by the police without repercussion. And fortunately, I was born a bit different from many others in my family and my community, with above average intelligence. I graduated from high school when I was 15. I started my own financial firm at the age of 25. And we've now been in existence for 16 years, working in the impact investing space for quite some time. We got our start working in public equities. And we started working with the Activest team to build out a municipal product that specifically addressed racial justice in a similarly impactful way that we were working with public equities. And you may have heard of our racial justice exclusion list. It's been covered by a number of major media outlets. And broadly speaking, we're an investment product company that's within the ESG universe, but we have an intersectional focus on racial, gender, economic, and climate justice. And we aren't simply creating portfolios, we're actually serving as a bridge between social justice movements and the public markets. So what's different about what we do is that we work very closely with the communities we intend to impact, both to build our own portfolios, but also to expand our impact well beyond our own portfolios and organize other investors to use those metrics as well. So it seemed like a very natural fit, our work with Activist. And so our allies are beyond other values aligned investors are really the social justice movements that folks are becoming more and more familiar with, like the Poor People's Campaign that has an intersectional focus on racial, economic and climate justice, One Fair Wage, which looks at gender, racial, and economic justice. You'll be seeing more about our work in the realm of the intersection between racial and climate justice. So those are our allies and our resources, and I'm really happy to be here and part of this conversation.
Thanks. And Benjamin, do you want to tell us about Praxis Mutual Funds, please?
Sure. Thanks so much. Appreciate it. So I'm Benjamin Bailey. I'm the Vice President of Investments at Everence, and we're the advisor for the Praxis Mutual Funds. But it might be useful for me to just kind of go back. I started at Everence back in 1999. Back then it was called Mennonite Mutual Aid. And Mennonite Mutual Aid, which is about 75 years old, was first started to help those conscientious objectors who weren't serving in World War II to be able to get aid similar to what they would have been with the GI Bill. So since the inception of Everence, it's been about mutual aid and helping communities. And since the beginning too, there's been certain things that have been screened out of portfolios, trying to keep things out necessarily. And as you might guess, with the Mennonites, it is a peace church. And so there's certain things that are related to war, but of course, alcohol, tobacco, those different types of things certainly too. But as I kind of progressed through moving from more of just the financial space, because I actually started more in the SRI, the socially responsible investing side at the beginning. And so trying to mix those two together as I moved from kind of assistant portfolio manager to portfolio manager. In 2006, a bond that came that we thought was extremely exciting was an IFM bond. It was the International Finance Facility for Immunization. And it really opened up our eyes to the impact that could be had by looking at different types of impact bonds. So it was to immunize kids across the world, and to be able to lend money to a project like that where you could really see the impact that was had was a powerful thing. And quickly after that, in 2009, it was green bonds, and later social bonds and sustainability bonds, each of those different things. And so the engagement part would occur as we would see the possibility of talking to issuers and helping them to understand the green bond principles and what things that they could possibly do to really have an impact. So we kind of put all of this together, not just screening things out, but really trying to look at how we can have a positive impact. Because in total, what we're trying to do at Everence and the Praxis Mutual Funds is we look through things through a stewardship lens. And so that's trying to balance the financial decision making with the financial considerations, balancing those two things together to make sure that we're having an impact with our money, that we're not only having not a negative impact, that we're also going to have a positive impact. Certainly there's going to be times when you're going to have to balance certain things, but in this case, kind of that balance is what we're trying to do. We've partnered with MSCI over the years, so they're definitely one of the allies that we have, because they've been extremely useful in terms of ESG research. Certainly Sustainalytics has been one of the partners that we've worked with more recently, trying to understand ESG. And I think that the space that we work in, which is kind of trying to bring impact to people that are investing, for their retirement or for, they're trying to outperform the Bloomberg Barclays aggregate. It's kind of a collaborative group in the first place. Lots of people, we know that this is one piece of the pie, and we can grow the entire pie. It's not that we have to compete necessarily with the other firms. We really want to grow the space and grow impact bonds, and through fixed income engagement with issuers and with investment banks, we think that that's definitely possible. So it's an exciting space to be in, and I appreciate being on this panel.
I'm going to flip the order and come back to you again, Benjamin, on what it was like as the climate bond started. And where you see that going the next few years and what the process was like. And then talk to Rachel and Ryan about in the muni market, the same thing, where there maybe aren't yet bonds or only a few bonds that do what they want to do, and how you start actually starting a new type of bond. So if you could start off with on the climate side or other parts that you've worked on there, Benjamin.
Sure. Yeah. So back in 2009, we were involved in the first green bond that occurred in U.S. dollars. That was with IBRD, the International Bank for Reconstruction and Development. So we were excited to be a part of that first issue because, again, we saw something with IFF, with the IFM bond, and we'd actually been involved with the wind farm and solar farm. So there are other bonds that we kind of understood the climate impact that could occur. But again, so that IBRD was kind of that next step in the green bond space. And so, to be able to do that, there was a new space to be involved in. And so after that, in 2014, the social space, so the first social bond with IADB, the Inter-American Development Bank, they came out with their I-bond for education, youth, and employment. So each of these different steps kind of, opened our eyes, and we wanted to continue to push issuers to make sure that they were continuing to do new and innovative things. And of course, our clients, they weren't necessarily saying, gosh, you need to buy a green bond, you need to buy a social bond. But when they heard about, the opportunities and the possibilities that were there, they were quite excited about it. Sustainability bonds are a little bit newer. One of the things that we want to see is just a continued growth of this market. And that means that there's going to have to be a balance between, pushing issuers to be dark green, and also making sure that there's probably going to have to be some things that are maybe a little more light green or medium green, so we continue to grow this space. In each of these things, there's always going to be a balance. We're hopeful that the sustainability bond market can continue to grow. So that's the mix of a social bond and a green bond. We think there's a lot of exciting work to be done there. That's one of the spaces that in 2020 has really grown the most, and especially with COVID bonds and COVID relief bonds. So we're excited to see, where the market's growing, and we want to continue to push, again, issuers and investment banks to keep expanding the areas that they think that things can occur.
And Rachel, as you're building out the bonds that you want to invest in, and are you finding the bonds that you do want to invest in, and are you feeling that you're driving the bond issuance, the bond spec? Do you bring investors along, or do you think investors are there and they need the product? And are you working with issuers and investment banks and council and municipalities, trying to pull them all along together, since you're building something from scratch almost?
I mean, it's very clear to us that the demand is there. People are looking for a way to address racial justice, and to do that using public market investments, which is where so much of our capital is tied up as a society, and so much of the power in our society. And we consult very closely with Activest as we're building the portfolios. We're starting out, as one must with any new portfolio, in the secondary market. Mostly at the very beginning, you're just kind of providing liquidity. And then as the overall strategy becomes larger, judicious new issuances will be moved into the portfolio. But Ryan can speak more directly to how we're partnering with issuers, working with issuers and community organizers in that space.
Just before we go to Ryan, and as far as finding the investors, are you finding this is a crying need, that people are saying if there's a way that we can start making the change via bond markets, that's a way to do it? And was this?
Absolutely. People are, public markets are really, many people want to be impact investors. Private markets, for their tremendous impact, have the downside that they're very illiquid for the most part. Public markets both have liquidity. Public market investments work inside of our retirement accounts and other vehicles that we have for holding them. And it's just where most of the wealth is held. in our society. And so people don't necessarily want to have to go into highly illiquid or complex instruments to have a lot of impact. And municipal bonds are one of the few ways inside of the public market where you are investing directly in communities. And by having this fiscal justice strategy, we're focusing that investment specifically on Black communities across the United States. And there's never been more interest. And we've been doing this work for several years. We've never had more interest. And we have many people who've been in this space for quite a long time saying this is the most innovative strategy for addressing racial justice in public markets that they've ever seen.
Can I ask you one more question, Rachel, before we move to Ryan?
Sure. I just want to make sure you get your full question answered so Ryan can talk about kind of on the issuer side.
The municipal markets often are locally based. A lot of the buyers are locally based, and there's tax for that, or there's just interest. People feel they can assess their own municipality. Are you seeing investors across the country that might be interested in municipal bonds in a specific city because that's where the impact can be made as a starting point?
Absolutely. Yeah, the fact that we can address racial justice in such a targeted and high impact way has broken traditional municipal bond investors out of their need to kind of only look for that taxable equivalent yields, kind of like look for the tax shelter or only be interested in the communities really that they're a part of locally. We have foundations that are talking to us about investing in this particular way who don't necessarily need the tax break and certainly are investing far outside of their own communities. It's really about the opportunity here for high impacts going directly to Black communities. They are all over the country, and the systemic problems that we are up against are spread across the country as well, wherever we have Black communities. So yeah, it is definitely breaking the mold for why one would invest in municipal bonds. People are doing it primarily because they care about justice.
Thanks. And Ryan, can you follow up on Rachel's points about how you talk with issuers, how you might talk with other entities, and how you balance the outright need and concern for justice with the dollar and cents arguments that you might make in specific examples, such as cities that are setting aside funds for settlements, et cetera?
Yeah, no, great question. So some of our issuer work, and we're working with cities in different aspects right now, but is really just some education. So just like I'm sure you're involved in some investor education, part of it for us is really helping them think about this intersection of kind of fiscal health and kind of racial and economic justice, and that those two things kind of flow in the same direction. They don't have to be mutually exclusive. So as your kind of, what does it mean to look at your budget from an equity standpoint? And that is, some of that is like raising the bar around what does an equitable community look like? How do you know that? We talk a lot about health and wealth indicators that research has shown to really drive long-term outcomes. But just like we talk about materiality from a risk perspective and a kind of credit analysis perspective, we talk to municipalities about what does material equity look like, to not just kind of give someone a program that deals with one aspect of their identity that maybe meets today's need, but how do you really do finance projects and allocate resources, do expenditure, generate revenue in a way that really gets to kind of material kind of equity outcomes. And so a lot of that work is, to be, if I'm truly honest, Activest, the highest and best use of us is to really facilitate and support and amplify incredible work that's been done on the ground around organizers and advocacy groups, folks that are doing research that is kind of bubbling up from the bottom and not so much being devised in a boardroom or in a city hall or a mayor's office. And so, there's folks like Good Jobs First that look at corporate tax abatements, and really the fact that tax abatements are kind of one of the most redundant and expensive ways to do economic development. And there's great research from everyone from Lincoln Land Institute to Upjohn Institute and others that show that there's better ways to support your kind of fiscal base by investing in local businesses and doing workforce development but so many communities give large amounts of revenue away. And so we work with, we've been developing with Good Jobs First an analysis on how do you not only look at the disclosures around economic development incentives and look at the debacle with Amazon HQ, but also really how do you make sure that issuers or that investors are aware of that risk. And so there's mechanisms like disclosure and transparency. They're supposed to be a part of GASB statement number 77, tax abatement disclosure, but only I think it's around half of cities are actually complying with that, showing the revenue they're giving away to abatements. And really the best way that abatements benefit cities is by kind of corporate by political pandering. So local elected officials, they get to get credit for maybe saying a corporation relocated to their city, but research shows that abatements only represent about 2% of a corporate tax structure. So they're not really deterministic around where a city is going to relocate or leave. Usually there's all these other site selection factors that really go down to the core of the fiscal base. How is the tax base? How healthy are the residents? Is there strong kind of economic security there? Is there strong transit and other things? And around police misconduct, we were working with Acre campaigns around the city of Chicago and their lack of transparency. So every year, Chicago, I think budgeted for around 40 million to 50 million in settlements related to police misconduct. And every year they blew that budget, and we're kind of, at least when we started the research, they were spending around 70 million per year, and that number has gone up certain years. And what do they do with the overage? Well, they get that from the general fund. So for a city that's already, teetering on insolvency, for them to kind of be charging taxpayers with the liabilities that are generated by law enforcement is not fair and equitable, because people that's not something that the residents did. That's something that that a particular department in the city did. And things like qualified immunity and others really protect law enforcement, where there should be better incentives in place, where if the police department is this kind of unmitigated liability, they should be paying the cost of the settlements, or they should have the real accountability with that kind of small group of officers that are really kind of generating the majority of those, those misconduct cases. And so, issues like that, fines and fees is another one. Chicago is unfortunately another example of here where they're, if you look at their CAFR, about 10% of their general fund revenues comes from fines and fees, and it's only gone up every year. And there was a great story out of Mother Jones where I think it was around 10,000 Chicagoans were bankrupt. And if you look, they looked at their bankruptcy filings, and at least half of the amounts owed were because they owed the city outstanding fines and fees. And so, it is become like a predatory revenues that the city of Chicago wouldn't be able to be solvent unless people were committing crimes. And these aren't generally these aren't violent crimes. These are motor vehicle violations that are generally overly targeted towards communities of color. So we're really lifting up those issuer risks to cities to say, this is not good for your citizens, it's not good for your investors, then why would you continue a practice like that? And then also looking at generative practices, what are things that you can do to raise revenue in a more fiscally just way?
Thanks. So maybe a question for all three of you, because some strands that are coming out of this and that also dovetail with the work that I do is, even though the fixed income markets pride themselves on being very highly numerated and highly specific in what can be measured, I think there's still a real short-termism in a lot of the dollars and cents valuation. And so I'm wondering, for instance, with the pandemic showing so many things that don't work the way that they should do, as well as being an exogenous event that has completely put any projections that people would have done last year to rest. Is one solution to getting the bond markets to work better, to obligating, whether it's the credit rating companies or other entities, to have a longer term outlook in the way you evaluate the bonds? Some of the things, for instance, Ryan, that you're mentioning, it might take a couple of years for this buildup of inequity to show up as a material balance, a big balance item, yet it's there the whole time. Or Benjamin, when you're talking about climate, there are so many risks to issuers from climate, way too many to start mentioning. But if one is looking at a year or 2 years out, they get missed. And my critique of the credit rating companies is, for instance, even in their fundamental ratings, they really only rate about 3 years out, even though the bonds may have a 5 or a 10 or a 30-year outlook. And I'm just trying to get a sense of how collectively the markets might be able to work a little bit better, almost to fix itself. So I guess should the analysis be, the dollar and cents analysis be longer term? And is the pandemic starting to show that or not? And go ahead, Rachel.
Well, I would say that, of course, we need to, from a time perspective, need to go farther out. I think that's kind of the story of our whole society, is that what may make sense in the short term, extractive behavior in the short term, doesn't necessarily make sense in the long term. In the long term, what really makes sense is sustainability. And that's what most investors are looking for in their portfolio anyway, are sustainable long-term returns. You get that from sustainable practices, whether you're a company or a government. So yes, it's longer term, but it's also greater depth in what is being analyzed. And what we find is that the ratings companies just haven't gone deep enough. They aren't looking at some of the important critical data points that Activest really looks at around how the budget is structured, what the fines and fees are on local residents. That actually speaks to a level of depth that, irrespective of time, still needs to be addressed. And these are primarily the things that impact the Black and brown residents of municipalities.
Thanks. Benjamin or Ryan? Okay, I'll keep moving on then. Benjamin, with respect to the climate bonds, where would you like to see them evolve in the next couple of years, and how do you assess impact right now? And do you sometimes have to evaluate trade-off between some indices or market general expectations and what your portfolios can deliver?
Yeah, thanks. I mean, in terms of what we're looking for, I mean, I think we want more and we want larger deals, because I was on a call not long ago listening into the IFC. They did a call and they were talking about the trillions of dollars that are necessary to really transform, the world, from more to renewable energy and energy efficiency and those types of things. So I think, yeah, we're talking about trillions of dollars. So it has to be, something where we can get the market growing. And again, the market has been growing, whether it's sustainability or climate or green or whatever phrase you necessarily want to use. The markets are growing, and they're growing, quite quickly. So those are great things. And in that, we always want to make sure too that there's strength underneath that, so that there's actual true impact. We don't want to have issuers that are bringing a green bond. When you first look at it, you think, okay, well, that's kind of light-ish green. And then when you actually see where the money is going, then you're thinking more, it's maybe like light brown or something like that, which isn't what we want, right? So we want to make sure that there's lots of issuance. We want to also make sure that in the end, these are going to places that really are going to have that true impact. But again, that balance point, is going to be a key thing. And so I think we got to continue to push for growth, and we got to help corporations. That's who we work with a lot of. But there's even, supranationals and groups like that. They need to understand the possibility of this market. And so sometimes, if you think about growth of the climate market, you think some people are concerned about the extra costs and, what goes into it. And our point to corporations is, these are things that you want to do. If you're going to be thinking about longer term sustainable business, you want to do these things in the first place. And so when you issue a green bond or a sustainability bond, you're really highlighting to those investment banks in the first part, but then, in the end, the investors that are buying these, they actually care about these things, that this is a long-term sustainable business, that this is something that you're putting money towards. And so when they see that and they think and it's not just about, did I have to spend a certain amount of money to get a third-party opinion or something, but it's something that they really should be doing in the first place. They can be or it's highlighting some of the things that they have been doing. And then in the end, really, what they're going to be able to get is they're going to be able to get a growing pool of investors. And that's what we've been hearing from multiple different issuers who were concerned about going to the green bond market, but then took that step, that they were impressed at the larger pool of investors that wanted to come in and buy their deals. And so in the end, does it cost them a little bit of extra money? Maybe. In some of these cases it does, but if it really grows that pool of investors that actually care about the deals that they're bringing, then really it does become a win-win. And there's going to be times that they're going to try to push deals too tight, meaning like it's going to get too expensive. And investors, we always have to balance some of those things, the financial gain, making sure that we are making the monies that investors expect, and also making the impact that we have. But there's great strides that we're excited to be able to see.
I'm going to ask a follow-up question to you, Benjamin, then the same one for Ryan, which is when you have these conversations with issuers, are they changing quickly enough? And particularly, on the one hand, we're saying if it's climate, it's an emergency. And yet, are the issuers starting to move in a way that the market will actually start being able to adapt to an emergency? Or does something else need to happen as well? And then, Ryan, I'm going to ask you the same thing with municipalities. You're speaking with the issuers. They might see the point, but if they think it's costly now, are they actually moving as quickly as you think they should be? But go ahead, Benjamin.
I think the quick answer is no, they're not moving fast enough. I mean, that's kind of how each of these things are. We'd love that for them to already be at a certain spot where they're hoping to be able to be in 2025, right? But so I think there's a couple things. Is that one, we want the issuers that are already doing good things to do great things, but we also want to talk with issuers that maybe aren't even so great in the first place, right? They're maybe not even good necessarily. They're kind of on the lower ESG spectrum per se. And if we can get them to move, to be good, if we can get the good to move to great, we think that can be a powerful thing too. We don't just want to have the strong participants get stronger. That would be great. I mean, that would be an important step. But we also want to make sure that issuers that don't see the benefits of some of these things actually understand if they do take 2, 3, 5, 10 steps that they need to be taking, and they will be taking at some point, but we need them to move faster. We can get each group kind of in that to take some of those next steps. I think really that's how some of these important challenges can be met. But in terms of big picture, how fast it needs to be, yesterday, a year ago, whatever. I mean, it needs to happen very, very quickly, but we need to continue to push these issuers.
And Ryan?
Yeah, I mean, I really like what you said, Veggie, around making kind of good issuers great, encouraging them to be great. There's a flip side of that where in some of the spaces that we operate in, issuers that are getting a lot of credit for kind of being, woke social justice leaders, maybe they have an office of equity or racial equity, and they're doing really, they're doing these great kind of announceables around a new effort that they're doing, or they're, taxing kind of, they're doing a really progressive, revenue policy. A lot of times, your ability, I guess a couple of things. One is there's a lot of performative things happening so that folks can market well, that they're on the kind of cutting edge of green or brown or whatever color you have. And one is that's kind of like a privilege to be there. It takes a certain amount of access and capital to be able to kind of present well oftentimes. And that is all too often kind of a surface level measure. And then secondly, we've found that a lot of communities, people hold up San Francisco as, one of the, kind of progressive city that's doing everything right. But, there's a reality that for San Francisco to do so many progressive policies and to look great, like you do that because you have such a wealthy, tax base. And part of your wealth or your tax base is because you've excluded, there was that movie, there's a documentary or a movie called The Last Black Man in San Francisco. And it's, you've displaced entire communities. And I'm not from California, so Rachel, you could probably speak to this more than me, but the fact that your ability to do good is because you did something dirty in the past. And I think that's an important thing that we need to talk about. What does justice look like in the present day, but also your ability to do justice now, or things that look just, might often be because of things that you've done in the recent past that people aren't really talking about. So I think that's important. And then there's another issue. You talked, Bill, you raised this question around kind of timing and the kind of the near termism of rating agencies, which are in some ways they're so my colleague Napoleon refers to them as a kind of a cartel. And we have a colleague
Right. He's right. Just
Yes, yes, another colleague, Destin Jenkins at his historian University of Chicago talks about, in the municipal market, there's a lot of money laundering, and by saying that, it's really like the revenues are derived or used for kind of predatory purposes. They're derived from predatory purposes. Some of the uses of proceeds are for some slightly questionable things like, police misconduct settlements. But in the market, it's kind of, you remove the unsavory purpose or how the origins of those dollars, and they just kind of go through the secondary market, and they look clean, they look great, they're tax exempt, they're beneficial, all cities are good. And we're just trying to make it aware that that's actually not the case. And so, but to the point I was making, there's I think an issue around disclosure. There was a question in the chat: what can investors do to encourage municipalities to improve their disclosure? And a lot of this relates to timeliness, but there's, continuing disclosure is one of the MSRB requirements, that you're disclose kind of material events that happen, a change, something that could impair your credit quality. There should be ongoing disclosures around police misconduct settlements, around civil unrest and social unrest. There should be more disclosure around extreme weather events. We should see pings around these disclosures all the time, but that's one of the things that we're not seeing. And so how can investors both support, push issuers to do that, not only just from a one-off call, but together as a kind of collective voice, but also how do you push the MSRB to do that, to really not make it a subjective matter to say, what do you disclose? Because if I'm an issuer, I want to say, I'm going to disclose as little as possible, and put as best foot forward as possible to make myself, look as just and fair and unvolatile as I can in the market.
Thanks. To be clear, if I had a wish, it would be to get rid of the credit rating companies entirely. I have 20 years of experience of working in them, and then 10 years trying to hold them accountable after the financial crisis. I think they're not a noxious, harmful impact on our economy. But the reason I suggest the comment on the methodologies is they exist today, and that is their Achilles heel. That is what their lawyers look at all day long. And I can say from my point of view right now, I filed a critique of Moody's ESG methodology. It's their global credit rating methodology for ESG. There's a lot wrong with it, but I found such a whopper, such a blatant lie, that I included the calling out of that in the comment. And I sent the comment to the attorneys general of New Jersey and New York and the US Justice Department. And I have gotten responses from New Jersey and New York. And my thought is, okay, if we have to live with them, let's get lots of eyes on them. Let's understand what their inputs are. Let's influence their inputs. Let's talk to them at conferences about their inputs, because they do have an outsized influence, even for debt that's not rated. We're getting a lot of questions, so I'm going to ask a couple here. And again, each of you can take it if you like. How do you think the recent Department of Labor ERISA rule, currently in commentary period, regarding incorporating ESG factors in investing, if enacted, will impact investments such as social and green bonds? And this is not my world at all, so if it's yours, please speak up.
I can say something, then others can comment too. I'm not going to get into like the deep DOL, some of those issues, just to be clear. But I'm just thinking generally, I think that this isn't going to be a positive thing for SRI ESG investors, because the fear can be in some of these cases that depending on where the line gets drawn and depending on how comfortable people feel with doing things that are kind of new and innovative and impactful, if they see that they could possibly get in trouble, or that they could, whether it's, and it's not right that they should in the first place, but whether they see that the easier path, less difficult path, is just going to be to stay away from some of these things, that's going to be a big negative. So, in terms of how that's going to impact the actual impact bond, space, whether it's green bonds or social bonds, I think it will have a negative for that too. There's most of these bonds, every once in a while, there's a few bonds that come where you can really see that they're probably bringing them through or inside tighter level than what you would expect if they weren't green. I don't think that happens terribly often, but every once in a while it does. So sometimes you might think, is that the best one to buy because you're getting a slightly lower yield? But I just think overall, the DOL getting so involved in these things is just not going to be a positive thing at all for just general SRI ESG investing. So I'm hopeful that it'll be changed though, or that it won't be kind of enacted in the way that people expect, or that a new administration will do something different.
Ryan or Rachel, anything there before we move on to the next question? Are most investors who seek green bonds or social justice bonds or any other bond other than a mainstream bond proactively looking for these opportunities based on financial performance, or is it also responding to demand for these type of bonds, sort of not irrespective of financial performance, but understanding that it might differ? I mean, right now, and where would you like to be in years?
I think we're all living through somewhat of a dystopian novel with the pandemic and the wildfires, and right, it's a kind of a choose your own adventure to Armageddon scenario that we seem to be living in. So not many of us, even in the asset management space, even the well-heeled, are feeling very good about where the world is. And I think it's bringing home this really core sense that, oh, maybe personal financial return isn't the only story. Maybe everyone going after their own personal financial return and relying on the invisible hand of the market isn't actually going to get me the world I want to live into and be part of. And so I think that demand is coming from a very gut sense that many investors have, that if we're all just kind of going after our own personal financial return and we're ignoring the social part of return, that we are all participants in creating, that we're doing something terribly wrong as we're kind of currently living through the impacts of that. So I find that the demand for an investment that both meets the financial returns that are like necessary and reasonable, and at the same time produces the social returns that reflect the kind of world that the investor wants to live into, that's really what the new ideal is.
Ryan or Benjamin?
I think that was well said, Rachel.
No, it's always nice to have a chance to smile when you're thinking of marching to Armageddon. I mean, at least if we have to go there, at least we can have a good laugh along the way. A general question about how the industry can better let people know about the bonds they have. For instance, a retail investor who is not an institutional investor, is not current on as many trends as institutional investors are, but is starting to hear about this and wondering how they can inform themselves and maybe learn a little bit more about the difference between deep and light green, or something that's really working as opposed to something that's just performative, as Ryan said.
Yeah, well, there's quite a few different points in there. I mean, there's definitely some, I mean, the green bond principles and social bond principles, those are great places to look in terms of if you want to get a better understanding of kind of what is the basis for some of these deals. I think the Climate Bond Initiative, they do a really good job of detailing some of the, interesting and innovative bonds that are out there. Sometimes it's really difficult for individual investors to be able to have access to some of these deals. If we're talking about like a corporate green bond deal or a corporate, like another sustainability deal, many of these deals, there's so many people that are interested in them, they can go really fast. So they don't have to go into any type of retail space whatsoever. If they're issuing a $500 million deal, sometimes those will be 5 or 6 times oversubscribed, meaning they'll have like $2.5 billion, $3 billion in interest within a couple hours. So, many of these issuers don't have to go very far at all in terms of getting the amount of money that they want. So they're generally not as easy for, individual investors to get. I mean, it's much easier to kind of go into the mutual fund space or an individual separate account or something like that, where people have access to some of these deals.
Ryan, with respect to the bonds that you're working on, Rachel talked about already a built-in demand, but is there a way for people who maybe aren't yet in the network that know of Rachel and you to learn about the bonds?
Yeah, I mean, one is, I would say, go to Adasina's site to check out Rachel's organization. And there's some materials on there about the research that goes into it. the portfolios that they've constructed and of how they approach their work, but also it ties in really well to the story of Adasina and their broader kind of framework around social change. So I think that's one thing, but in general, like education about really from like a strong justice lens, particularly in the muni market, it's hard to be able to find places to learn more about that. There's not a kind of organization or clearinghouse that does it. There's not great kind of there's green bond principles, and then in the European context, there's a little bit around social bonds, but there's very little written about kind of what that looks like from a true justice, kind of transformative standpoint, that you're really trying to get at deep systemic issues and talk about dynamics like racism and class and gender-based violence. So some of we're actually putting out a report sometime in like the next week or so on what does social justice bonds look like, and doing some case studies and analysis that I would love to share with the Croatan team. But there's very little around that space, and I think a really big void there.
And just the bond markets, as you know, Bill, are notoriously opaque. And so it's just kind of hard to get information about the municipal bond market the same way that you can like public equities, for example. And the truth of the matter is that the work that we're doing is really on the cutting edge. I mean, Ryan and his team are digging into PDFs, right, that have not that aren't easily kind of like put into data sets that are downloaded, from a Bloomberg terminal. So it's original research that's happening. Our hope is that that as we build assets, there's more of a resource base to share that more widely. But I mean, we're really at the very beginning of doing original research on something where like the information is out there about how municipalities are structuring their budgets, but it takes some serious effort and a particular lens in looking through all of those public documents to actually pull up a data set that's usable.
It's the same with my work as well. There's a huge amount of almost journalism in it, and that the information is there. Sometimes you need a FOIA, sometimes you just have to read 300 pages and look through and then read through it again. So it's both sort of the challenge and the fun of doing something from scratch, or something that needs to be done really and hasn't been done yet. We're getting towards the end. Do Benjamin or Rachel or Ryan any quick parting words before we move to our sign off? Doesn't look like it, I guess, if you're doing it. So I want to say again,
you've covered all of the topics very well.
Yeah, thank you.
Thank you.
I really want to thank the panelists today: Rachel Robasciotti of Adasina Social Capital, Benjamin Bailey of Praxis Mutual Funds, and Ryan Bowers of Activist. Thank you very much. And thank you to our sponsors as well, and to the partners of Croatan Institute, including Breckenridge Capital Advisors, which is a founding supporter of Croatan Institute. Please support Croatan Institute Conversations if you enjoyed this conversation. There are many ways to support them going forward. You can ask your firm to sponsor a future conversation. You can make a donation to croataninstitute.org/donate, or do so when you're registering for a future conversation. And please provide feedback on the survey form that's going to pop up at the end of this conversation. Also, please help us. We are a nonprofit research institute. What we want to do is fix the world and make it work better. Please look for us on Twitter, Facebook, LinkedIn, YouTube. Just like what we post, or ask us for more information. And the last slide, Susan. And again, reminding the upcoming Croatan Conversation, December 8th, Tuesday, 1 o'clock, with Croatan Institute President Josh Humphreys and US CIF CEO Lisa Wall, on the dialogue on trends in sustainable and impact investing in the United States. Thank you very much. And personally, thank you very much to Croatan Institute for having supported my work in the last 3 years. There was a real whistleblower aspect to what I do. Whistleblowing can be lonely, and I'm thrilled to have my colleagues at Croatan Institute. Thank you very much.
Thank you.
Thanks, everyone.